We'll go ahead and get started. If everybody's got their coffee refill and food, thanks again for coming out to our third annual construction risk update that we do in the fall. I'm glad to see everybody here in person. Nice to be able to get together, so very much appreciate that. We've got a pretty full agenda today with some experts on certainly insurance, tax, state and local tax as well. Joe, resident counsel, appreciate you being here. Jim Suddy will be here and talk about lease accounting changes and what that means for the construction industry. But we do want to make this kind of an open forum, so by all means, raise your hand, interrupt. We want to have discussion. We want to hear what's going on with each of your businesses as well. So, please be sure to just raise your hand or shout out if you have any questions and want to discuss anything, because it's fun to hear about everybody's experience and stories and things like that. That's the value that we have in terms of getting together. So don't hesitate to do that. So we're going to kick things off today with Jim, I believe, correct? Going to talk about lease accounting. He'll go for 20 to 25 minutes. Then we'll have Joe Pop that will transition into some sales and use tax and other SALT issues. And then from there, we will go to Joe, I believe, correct? Talking about what's going on in the insurance and other areas of risk, builder's risk, cyber, some other issues like that. And we also have Scott and Melissa from our tax team that will talk about federal tax issues and some of what's on the horizon with regard to that. So we've got a fun group today. And again, please raise your hand, ask questions. If there's topics that we aren't covering that you want to discuss or want to hear what folks think, by all means, bring them up and we'll pose those questions to the audience as well. So with that, we'll go ahead and get started. Thanks all for being here. We will have a recorded version of this available as well. However, CPE will not be available with that, but we'll get that routed around to all attendees and other folks next week. So any other housekeeping items, Imani, that we need to address? All right. With that, we'll get going. Here is the clicker, Jim.
Good.
Thank you.
Good morning, everyone. I am Jim Suddy. It's a beautiful Thursday morning, and what better way to start it off than talking debits and credits? Boy, isn't that going to be fun? All right. Hopefully I can handle the technology here. There's Doug. And there's me. So I'm going to talk about lease accounting. And this presentation is normally about 2 hours. We're going to kind of whittle that down to... Well, thanks, Doug. So we're going to whittle that down to about 15 minutes. So if I'm talking, and I'm dating myself here a little bit, but I'm talking like the guy from the FedEx commercial, if anybody remembers that, talking really fast. So we're just going to hit the really high points, so we'll just go from there. So anyway, the lease accounting standards. So the FASB, in their infinite wisdom, said that there are many companies have these operating leases, which is technically an obligation, but it's not on the balance sheet. And they said, well, you really have an obligation, which is it's really a liability. So what they did is they created this thing called Topic 842. I won't bore you with the technicalities, but it's in the ASC. It's Accounting Standards Codification. So anyway, so 842 it supersedes 840. And again, it applies to only leases of property, plant, and equipment. So it doesn't apply to things like inventory. Okay, so what are some of the highlights? So the biggest thing, the biggest change is that all of these companies who have operating leases, those are now going to end up on the balance sheet as a right-of-use asset and a lease liability. So now they still, under the current standard, there's also this thing called capital leases. So that will still exist, although it'll now be called finance lease, minor name change, but still the same concept. So you'll have operating leases and capital leases, and they'll both be on the balance sheet as a right-of-use asset and a liability. So what I talked about a second ago, the capital leases, which are now going to be called finance leases. Under the current standard, the old standard, there were these bright line tests to determine whether or not you had an operating lease or a capital lease. So the criteria for a capital lease was, okay, does the lease exceed 75% of the useful life of the asset? Does it exceed 90% do the payments exceed 90% of the fair value of the asset? Is there a bargain purchase option at the end of the lease to buy it? Or is title transferred at the end of the lease? Those were the four criteria. Under the new standard, that is one reasonable approach, and I think a lot of people are going to be doing that. Just say, okay, this is what I have a capital lease now. I'm using these same criteria to kind of determine, I still have a finance lease. So again, definition of a lease hasn't changed that much. So you can see under the current standard, previous standard, it's an agreement conveying the right to use property, plant, and equipment for a stated period of time. Slight change in the definition. It now uses the word a contract or part of a contract that conveys the right to control identified property for a specified period of time in exchange for consideration. So basically the same thing, but a slight modification to the wording. Again, the two key differences, the new definition, it mentions that it's part of a contract, which wasn't in the old standard or the old definition. And it also specifically states that an entity has control of an asset. So, and the reason that's important is that you could have, if I'm leasing something, I have the right to control that asset and use it as I see fit. And the lessor can't change out the asset, they can't, modify the terms once we've signed the contract. So that's really the key is that I have, as a lessee, I have control of that asset. Again, I have the right to direct the use of the asset and how and the manner in which I use that asset. We have a polling question.
This is for your CPE.
So, everybody read that?
Yes.
We're done? Okay. Okay. Commencement date. This is pretty self-explanatory. It's the date on which a lessor makes an underlying asset available for use by the lessee. Kind of no-brainer, right? And the date on which the lessee is required to measure or record the lease liability, and the lease payments not yet paid, and the right of use asset. Pretty self-explanatory, like I said. So how do I record that liability? So what I need to do is take the present value of the payment stream on that lease. So what rate do I use? A couple of different options here. Some leases have a rate that's implicit within the lease agreement, so you would use that rate if that's the case. Many leases don't. And so in that case, you would use, if I'm a company, I would use my incremental borrowing rate. So what can I borrow funds at if I'm, if I have a 5-year lease, let's say. If I were to go out and buy a piece of equipment, what would be the rate that I'd have to use or pay, the interest rate that I'd have to pay to buy that equipment? Or there's a third option, and this is for private entities only, that you're permitted to use the risk-free rate. And I would say, I would recommend that, there's no such thing as a risk-free investment. My recommendation would be to add a point or something to that. So again, those are the three options with the lease, or I'm sorry, with the lease rate. The lease term. So it isn't necessarily what's on paper. So the lease term should be what you have on paper, the non-cancelable period. And then you have to consider, you have to get your magic 8-ball out and think about, how long am I going to renew this? So are there renewal options? Let's say I have a 5-year lease, and then I have an option at the end of the lease, or at the end of that 5-year term, to renew it for another 5 years. What's the likelihood that I'm going to do that? And if it's pretty likely, if it's likely that I'm going to renew that, then my lease term is not 5 years, it's 10 years. Even though I haven't signed that extension, if it's likely that I'm going to do that, then I do have to add that to the term. So it's a 10-year lease as opposed to what's on paper, again, 5 years.
Jim, this is a key point. I think we get this question a lot.
Sure.
Folks that say, can I just get around this and structure it so that on paper it's a 11-month lease and then I don't have to worry about it. But again, you bring up a key point here. What's the real likelihood, say, that you're going to go beyond that period of time?
Exactly, Doug. Yeah, you can't, people can think they can play games with it to say, okay, well, it's a short-term lease. I don't have to put this on my balance sheet at all. Well, you have to look at the economic reality. What am I really doing here? If I've got a lease, I can't say, well, yeah, I'm only going to use it for 11 months, but then I'm going to keep renewing it over and over and over. If it looks like a duck, walks like a duck, quacks like a duck, it's probably a duck. So all that said is, you really have to, again, get your magic 8-ball out, but you can't just kind of skirt the standard and say, well, it's a short-term lease, I don't have to do it. So it's really, what's the true intent of this lease? Thanks, Doug. So, the overview, and this is kind of a comparison of a operating lease and a finance lease. Now, as you can see, the top of that, or I'm sorry, the top of that is a finance lease. So again, you have a right of use asset. So I have the right to use this asset for some period of time. And the other side of that, the credit side of that, is the lease liability. And it's pretty much treated like a loan. So you have amortization expense, you have interest expense. And on the cash flow statement, it would go in the principal payments would go in financing, and the interest expense would go in the operating section of the cash flow. I don't want to get too deep in the weeds there. The amortization expense is really the amortization of the asset that you have the right to use. So again, you're not amortizing the physical asset itself. You're amortizing the right to use that asset. It's a pretty significant distinction, because some people might say, well, if I've got an asset that's 5 years old and I'm leasing it, it doesn't have any value. Well, no, I still have the right to use that asset. So there is some value in the right to use that asset. So that's something to keep in mind. And on the bottom is an operating lease. Excuse me, allergies. Again, you have a right of use asset and a lease liability. In the income statement, it's just a single line. It's just lease expense. And it's amortized or expensed on a straight line basis over the term of the lease. And it's usually under the cash flow statement. It's an operating activity. Operating leases. Again, so I recognize a right of use asset, and I recognize a single lease cost. So it's basically, again, if I have, let's say I have lease escalation payments. So in year one, I'm paying $100 a month for this lease. In year two, I'm paying $150 a month. I'm going to smooth that out. Over the term of the lease, it'll be, let's see, just say it's a 2-year lease. It'll be $125 a month. Does that all make sense to everybody? We're all smart people here. Well, I'm not, but most of you are. So in that operating lease example, this is what the kind of over the term of, this is a 5-year term, this is what it would look like. So you have the lease liability that gets paid down over time. I'm making a cash payment of, in this case, $10,000 a year. Part of that goes to interest. I have a right of use asset that gets amortized. And I have a straight line, again, straight line lease expense. So it's just $10,000 a year. And this is what the journal entry, again, debits and credits, love them. This is what it looks like in year one. Debit the right of use asset, and I credit the lease liability. Okay. Finance leases. Pretty similar to what we call capital leases now. It's really not all that different. Again, you're required to classify it as a finance lease when it meets any of the criteria that we talked about before. And again, the reasonable approach that I think most companies are going to use is the current capital lease criteria. So again, same concept, recognize a right of use asset and the lease liability, and then in the cash flow you would classify the payments depending on what they are, what portion goes to principal, what portion goes to interest. The principal is a financing activity, and the interest is an operating activity. So key differences, we talked about this from the current standard or previous standard. Again, there are no bright lines, but there is that option to use those same criteria that we currently use for a capital lease. Again, some of these things are a little bit repetitive, but just kind of driving the point home. This is what a financing lease looks like. This is what an operating lease looks like. Lessor accounting, that hasn't changed all that much from current standards. So again, we're looking at this from a very high level this morning. So I'm kind of going to gloss over that a little bit, if you don't mind. Again, it doesn't change all that much. Okay. When does the lease transfer ownership of the underlying asset to the lessee? So that's our polling question.
While we're doing the polling question for some of the bankers that we have in the room, if you
bottom line to the income statement and balance sheet on a, $250,000 deal? What's the cash, all this change, what's the bottom line impact?
Yeah, the biggest impact is, again, is going to be in the operating leases. So you're going to have this asset on the books and a liability.
Right, so the balance sheet is going to be heavier on the debt side.
Right. Yep.
Reduces net worth of the company.
Yep.
And then cash flow,
Well, it shouldn't change the net worth, the big
if your debt goes up,
change would be inside the working capital test or current ratio, because now you could potentially have a portion of this in your current liabilities.
Yeah, and we'll touch on that in a little bit.
None of this really going to be current asset. That's
but on the cash flow side, is there much of a change? You're still putting out the same amount? Right. Yeah, I get that.
Right.
It's a 5-year, 10-year thing, it would be more, right?
Well, it'll change the liability. I mean, you're still paying the same amount. It just changes the amount of the liability that you're booking, the present value of that liability.
In an indirect way, that answers your question. I don't think we've seen it. How do you know we've never looked at it?
Yeah, but it's something obviously to be aware of, to move forward in terms of building that into your calculations. For sure.
Yeah, again, we'll touch on that in a little bit. Because that is, to me, is going to be the biggest impact.
By the way, the answer here is by the end of the lease term.
Related party leases. This is where we get a lot of questions, too. Oftentimes, if I'm a privately held company, privately owned business, I own the building, and I'm leasing it from myself. So I may own that building through another entity, typically through another entity. I'll set up an LLC to own the building, and then the operating company will lease the building from the LLC or from the real estate entity. So there's varying schools of thought on how to do this, because oftentimes an entity doesn't have, if I'm leasing from myself, why do I need a lease agreement? So I don't have a lease agreement. I'm leasing it month to month. Again, what's the economic reality of that, though? Do I really have a short-term lease? Maybe, maybe not. Probably not, though, because chances are I'm going to stay in that building for more than a year because I own it. So in that case, you still have to determine what's the, again, get the magic 8-ball out. What's the best guess? What's the likelihood, or what's the likely term of that lease? Is it 10 years? Then I've got it. Then I've got a 10-year lease, even though I don't have a lease agreement, or I have a month-to-month agreement. The reality is, it's more than month-to-month, and it's more than 12 months. It's something greater than that, and so under GAAP, generally accepted accounting principles, I've got to book a liability and a right of use asset for that. Again, it's legally enforceable terms, how you account for related party leases. But again, as we just said, a lot of those leases are not accounted for at arm's length or aren't even documented. But it's still a lease. Effective date and transition. Public entities have already started doing this, so they're already on board. For private companies, not-for-profits, most not-for-profits, essentially it's for calendar year 2022. It's for periods, again, beginning after December 15th, 2021, basically for calendar year 2022. Now, if you're doing quarterly reporting and you're a calendar year entity, That doesn't mean you have to start reporting on this, like, let's say Q1, so March of 2022. But, and I would strongly recommend that you start doing this now. You got to get that lease inventory. You got to figure out, what do I have? What do I need to record? What are my assets? What potential liability do I have? Something we have to have. We have to start talking about now, as opposed to, well, okay, I have until my 2022 reporting. I don't have to worry about it until then. You're going to be in a world of hurt if you start in 2022. So, or I'm sorry, at the end of 2022. So, something we touched on a little bit earlier, the implications. Ratios. So, debt to equity increases. Interest coverage decreases. EBITDA increases. Return on assets, current ratio. That's one of the biggest things. So, again, we talked about, if now you have, especially with operating leases, you now have a current liability for the next 12 months of that lease. That messes with the ratios, because my current ratio is skewed now to some extent, because I've got a non-current asset, that right-of-use asset. There's no current portion of that right-of-use asset. It's basically like having a piece of equipment, but it's a right to use that equipment, but it's still a non-current asset. But again, part of that lease liability is current. So I've got a little bit of a change in my current ratio. So it's something definitely to consider, and I know we have a lot of bankers in the room. If you're talking with your clients, or vice versa, clients when you're talking with the lenders, you may want to talk about maybe renegotiating covenants, talking about covenants, saying, okay, this is going to be the impact on these ratios. Let's sit down and take a hard look at what impact that has on those financial covenants. Related party leases, again, we talked about that a little bit. And then you have non-lease components. So that could be taxes, interest, et cetera. There is a practical, what they call a practical expedient under FASB, where you can lump all those into the lease payment. So if I have taxes and insurance and the actual lease payment, I can put those all together and call it one thing, just call it lease expense. Don't have to, but again, something to consider. And that may, people may change over time how they look at leases and how they account for them, and how they account for those other things, like CAM is another one. So again, taxes and insurance, just talked about. May change lease versus buy. So I may take a harder look. Do I want to buy this asset as opposed to leasing it? And that way, I'm not messing with all this other stuff. I'm just purchasing it outright, and I don't have to worry about, okay, do I have a 5-year lease? Do I have a 10-year lease? How long am I going to use this? I'm just buying it and I'm using it and it's mine. Can you track leases via journal entry, or do you need a lease tracking software? Okay, I'm getting the hook here. So again, this is normally a 2-hour presentation, so I'm trying to cut this down as much as I can. So again, I would recommend using an asset tracking software, like there's one called Creative Solutions. So it's kind of similar to tracking property and equipment, so you can amortize it over the period of the lease. So I am finished with my presentation, and if you have any questions, you can talk to me or my partner, Cody Neese. We'd be happy to help you, and with that, I will yield the balance of my time, even though I've gone over.
I know, right? It's crazy. Baby-faced young man. Good morning, everyone. Good morning. Hey, all right, excellent. Hello, my name is Joe Pop. I'm an attorney. I'm the director of our state and local tax group at Rea Associates. Thank you very much for coming out today. I'll echo Doug's comments. It's great to see everybody in person as opposed to virtual, as we've been forced to do for a while now, so it's great to have everybody out. Today I've got a relatively short slide deck. I have 2 slides for you. So we're going to go mostly story today and also questions. So if you guys have questions as I'm talking about things, feel free to raise your hand, ask. You know, there's a lot of things we could talk about in state and local tax, leases versus buying, what disguised sales look like, sourcing of leases, lots of different things in that area that are also state and local tax issues. But what I've sort of prepared for you today is one of the major changes that's come down in state and local tax since really the 90s. So this is sort of a major milestone event in a career. So for people that have been in the finance area for a while looking at state and local tax, this is a big change. It's not a small change. And so I'm going to tell you a little bit about that and talk to both the construction folks in the room and then also the bankers in the room. I have a little bit of things for both of you. So, you know, in the construction space, in some ways, you guys have it really good from state and local tax perspective, and in other ways, not so great. On the good parts, when you go someplace, you know you have nexus there. When you're doing a project, you've got employees there, you have subs there, you have agents there. You know you should probably be thinking about doing some kind of tax compliance in that space. So if you're in West Virginia, you should be thinking about doing some kind of tax compliance in West Virginia. What are the requirements? You're used to this great municipal tax system that we have in Ohio, where, right? Yes, I see some nods and things of yes, this is great. So municipal tax, I didn't invent it. There are wonderful things that you have to worry about with municipal tax. When you're there for a period of time, you have to withhold on your workers, you have to file income tax there, but you guys have been doing that for a while. Those are some of the things that this Wayfair case has really changed for people that aren't in your industry, for vendors and for retailers. They're not there, right? Mostly they're online. They've got a warehouse. They do a lot of shipping. They don't have agents and people on the ground doing stuff for them. And in the past, in the 90s, there was an old case that basically said, hey, for sales tax, you got to be there. You have to be physically present in some way before we're going to make you collect sales tax, you know, on your customers. So they had sort of this construction rule where if you're not there, you don't really have to worry about it. That all changed with this case called South Dakota versus Wayfair. How many people have heard of that case, by the way, in other presentations? Quite a few of you, not too much of a surprise. It was kind of big news at the time. And essentially what that said is, as you see in the middle part of the slide, sales tax nexus can be acquired just by sales. You don't have to be there anymore. You can just sell stuff. And this was a big change for a lot of people. So let me run through some of the things going through these vendors' minds. Wait, we have to do tax filings? We have to figure out what the rate is? We have to figure out if our stuff is taxable, whatever it is that we sell, be it pens or microphones or tablecloths or whatever. What about our customers? Are they exempt? How are they using it in all of the states we sell to? This is all brand new stuff for them, for the vendors. You guys have been dealing with this stuff. As I have in the next slide, you guys have some issues in the construction industry area. Is it a construction contract? Is it installation of tangible property? That's a really gnarly problem. But these guys aren't used to dealing with that. And so the very first bullet point that I have up there for you, the national change to sales and use tax impacts you through your suppliers. It's because your suppliers don't know what they're doing most of the time. And to the extent they do know what they're doing, they're worried about rates and tax filings. They're not necessarily in tune with what you guys are doing and what your tax status is. So let me give you an example. We have an online retailer that sells into the construction space. They are entirely on the residential side, and they're focused on one area of the home. And I won't, tell you the specific area, but it's one specific area of residential housing. And they sell to all sorts of people nationwide. They've done zero compliance at the time we talked with them. Sales tax, income tax, nothing, because they're based in Ohio. They have a warehouse here, and then they ship everywhere else. So how does that impact you exactly? Well, this vendor was selling primarily to construction contractors. And for the most part, in most states, when you're doing construction contract work, you're doing a new build, you're doing a major renovation, either the sub that's purchasing the items, or you, if you are doing the work yourself, or you're buying the items and having a sub do the installation, you're the end user, you have to pay tax on it. And these guys hadn't been charging anybody tax. So there's a couple issues with that. The first one is, in a lot of construction contractors that I talk to, the control for whether or not something is taxable is whether the vendor charges them tax. Right? And you're like, well, they know what they're doing. They know what our business is. They know their industry. Clearly, they're looking at this. But most of the time, they don't, and they haven't. And that's because, for most of them, they didn't need to. They didn't need to do tax filings in the past. So when we look at this area, and with my example of the online retailer, what they ended up doing is going back to all of their customers and asking them to pay tax a couple years back. And this wasn't something that was on the balance sheet. This was an unknown liability. And you don't really know which of your vendors is going through this process and having that aha moment with the Wayfair application to them. They're doing it at different times. So it's not like everybody got on board with this at the same time. It's being phased in over time. And so they ended up doing that. They ended up making a decision that for some states, they were going to do a disclosure backwards, give that tax to the state, tell them about who their customers were. And then in some states, they were going to make a decision to go forward and not, do a backwards filing, which is a decision many of you have probably encountered, in your own businesses. As it happens, a couple of the states decided to audit them, and they ended up having to disclose their client lists under audit. So what all that means for you is the vendors that you have, if you're not involved in a great deal with your finance function in your company, for those of you in the construction side of the world, you might ask, when we have a customer or a vendor that's selling us stuff, are we doing a review to see whether or not we need to pay tax on it? Are they charging us tax? What are they out of state? Are they in state? Where are they? The big box stores of the world have done this already, right? They're here, they're in jurisdictions, they know that they have to collect sales tax. If you go to Lowe's and try and buy stuff exempt, they have a whole process, in place for how you do that. But for a lot of these vendors that you may be buying from, they don't have a process, they haven't looked at this, they're just trying to get up to speed. And so this can be a big impact, for you. On the banking side of this, this is a very hard thing to diagnose. And, quite fairly, it's hard to really estimate if there is a problem or how big the problem is for disclosure on a financial statement. And so there are some questions that you might ask if you wanted to know, well, we have this construction contractor and this one. Are they looking at it? What's happening? You can ask if they have a control for when they buy stuff. Are they doing a review to see if sales tax or use tax needs to be paid? Yes or no? What exemption certificates are they giving out to people? It's very easy usually to diagnose whether there's a problem. It's hard to quantify it, and it's kind of hard to fix it sometimes. Any questions on that general point before I move on to the next kind of section? Yes.
Are you seeing much with use tax audits on people?
Yes. So, great question. Ohio specifically is kind of cyclical. They go through industry groups at the same time because they want to compress issues so that they can bounce things off of each other, and the management group is seeing things as a whole. A few years ago, they went through cheese-making folks in Ohio, so all the cheesemakers got hit. You might not think there's a lot of cheesemakers in Ohio, but there is. And so they just completed a cycle on construction contractors, general contractors and subs. And we were involved in some of those. The issues there tended to be this issue specifically, Wayfair with vendors, and the other one tended to be general contractors whose accounting practices got a little lax, and it looked like they were purchasing assets and then having subs install them, rather than having the sub do the purchase and the installation, where the tax would be at the sub level. If you're a general contractor and you buy materials and you have someone else install them, you're the one that typically has to pay sales tax or accrue a use tax. So those were the issues they were looking for. They were looking for out-of-state vendors for the most part, some in-state too, and then also these sort of lax, where things got moved into a purchase order and then kind of slid into what looked like a purchase. Those were the main issues that have come up on that. The other thing that Ohio has started to do is to look at cost segs. So if someone has a new build, they do a cost seg because they want to get a better federal tax treatment. Ohio can see all of that from the feds, and then they look at that and they have a nice breakout of this is real property, this is tangible property, and they're like, great, we can take this as a blueprint to go and audit that build and see if they did the tax right. So they've started to do a little bit more innovation on the sharing agreements between states and also the data mining from feds to try and generate more leads on the use tax audit side. Great question. So, the other thing that I wanted to share with you, and again, like Jim had mentioned, we can talk for hours about these topics, which is good and bad. We don't want to do that because all of you would be asleep. But if I'm going to give you another 10 minutes on this, the other thing that I wanted to mention is, for the most part, when I'm out talking with construction contractors these days, it's not so much about construction, it's about manufacturing or restaurants, other industries. Why in the world would I be doing that? And the reason is, this can really be something that gives you a competitive advantage over your competition if you're looking at it. We recently had a big client of ours who had a new build manufacturing facility, and they asked us to come in and take a look at everything. And it turned out that their contractor had overcharged them about $200,000 of tax inside of the build. And the reason for that is, one, they were going out and sourcing manufacturing machinery, and they kind of got that mostly right, but not all right. But the other thing was, they weren't really looking at, from the sub to the general contractor to the client, who pays tax and who never pays tax. I'll give you a quick example of this. Let's say that you're a general contractor and you have a manufacturer that you're working with, and they say, we'd like you to build this brand new facility for us, and then go out and buy all these machines and install them for us. So you're going to have all the normal costs for your building, and then you're going to have these manufacturing machines. You don't really know anything about those, so you have an agent go out and buy those for you. You want to make sure you get the right ones, maybe get the better price. And so you have this manufacturing machine that, let's say your sub goes out and buys. They sell it to you. They don't charge you sales tax. And then you sell it to your manufacturing client, and you don't charge them sales tax either, because that's exempt, right? Manufacturing equipment generally is exempt. Okay, good, awesome. When that manufacturing machinery goes into the facility, often it needs a concrete pad that's a little thicker than the normal floor. It's big, it's heavy, and it needs to be set on a specialty piece of concrete. That specialty piece of concrete in Ohio is a business fixture eligible for the manufacturing exemption. Not true in all states, but it's true in Ohio. Case in point, sub goes out, buys the concrete, does not have to pay sales tax on it. Just like the manufacturing machine, same status. They sell it to you, you sell it to client. No one pays sales tax on the concrete at all, ever, because it's exempt under the Ohio manufacturing exemption. Easy to see with the manufacturing machinery, less easy to see with the concrete, but it's the exact same status, exact same concept. Ohio doesn't distinguish between the two things. How does that help you? Well, if you're going and bidding on a big building for a manufacturer, what components of that building does no one pay sales tax on the materials? It's quite a bit, actually. If you're able to go through and look at that and understand what their manufacturing process is and what the specialty items in your build are going to be, you can cut out 10% of your materials cost or your subs cost and pass that savings on and maybe win a few more bids because you're able to do that versus someone who just decides, well, my sub is going to charge me X dollars for this concrete work. I'm going to upcharge it. I don't want to cut into my margin too much. Here's my price, for that line item. Whereas if you've gone through and done this sort of analysis, you can cut that sub price by a particular percentage. You can pass that savings on to your customer on the bid. And if you add all of that together, it can be quite a bit of savings. I'm getting the hook from Doug as well. So just a couple of last thoughts for you. It's not just manufacturing, it's also restaurants. Restaurants, if you have a walk-in cooler, that can be exempt. But what if you have a Subway? They have walk-in coolers, but they also have other kinds of coolers. Are those exempt too? What if the Subway is in a convenience store or gas station? It can impact and change how that flows through a Subway that's a store, a restaurant, and a Subway that's in a gas station, right? All of those are slightly different. And the last piece I'll leave you with is, if you're going out of state, the rules are very different. In Ohio, if you do a repair to real property, it's not taxable generally. West Virginia has a 60-page rule that goes through why, in some cases, repairs to real property actually are taxable. So it's definitely not safe to think that the Ohio rule applies to the other states. On the banking side, same kind of concept. It's really hard to know if this is an issue for your construction client or not. It's good to sit down, have a conversation. What kind of controls do they have? What kind of controls might they need? And again, it doesn't have to be big exposure, but tends to be, if you're not looking at something, you probably have some exposure. So.
Talk a little bit about what you do and what you see with regard to M&A activity and doing assessments related to that, and how maybe that's impacting.
Sure, great question. So on the M&A side, typically when all of these things come to a head is either when you're going and you're doing a big line of credit increase and the bank wants to take a look at it, or you're doing a sale and you're going to have a buyer come in and do due diligence. And we do this too, buyer due diligence. If I come in and I'm looking at a company that's going to be acquired, the first kind of questions are, what are your controls for if you buy something and should sales tax be collected or remitted and use tax? I see that you're in, 5 states. Where's your tax returns, for those 5 states? Relatively easy to find the issues. On the M&A side, these things can, aside from income tax, they're embedded in EBITDA. So income tax is excluded out. Everything else is included in. Sales tax, unclaimed funds, all of that. And so typically what we see is the buyer side due diligence wants to reduce purchase price by possible liability times whatever multiple you're using. And that's a big number. Sometimes that blows up a deal. Other times you have to go and kind of rush to get it fixed at 1 times EBITDA, right? Like you're just paying the liability. So I hope that's responsive very quickly to the question, but these issues do come up in a sale transaction, proposed sale transaction. It's definitely useful to deal with these ahead of time, because if you have these things done a couple years in advance, when the buyer side team comes in and says, give us the last 3 years of tax returns, show us your policy document, You already have that done. And you just give it to them, and they're going to pass on it. And even if you've had issues, going back a long time, if you take corrective action a couple years before a sale, you can pass most due diligence. If they're not going to go all the way into the weeds and look at, the whole history of the company, you can really save yourself tremendous money and trouble by doing it a couple years in advance. So, yes?
If I'm doing work in different localities or maybe different states, would you recommend doing a nexus study to determine where I might have taxable activity?
That's a great question. So, again, mostly in the construction side, you know where you have nexus. You're there, right? You've got people there, you have agents there, etc. In other industries, definitely a nexus study to look at, have I tripped the requirements? Most often, with an industry like construction, I actually think a risk assessment may be more useful, where you're just looking at, okay, so I know I'm here, I'm in Kansas, but I was in Kansas once, and my exposure is, $500. Well, who cares? Or I'm in Kansas and I have to file there, but man, I've got, a couple $100,000 that I'm potentially exposed out there for. So it's a great question. It really depends on what the industry is, on whether a nexus study is really useful these days. For construction, I'd say maybe not. More risk assessment, like just where do you owe stuff potentially, and then assume you have nexus kind of anywhere you play. Other questions? All right, well, thank you very much. I will cede the rest of my time, even though I'm over, to the next presenter. One poll question here. What case allows sales tax nexus to be obtained by remote sales alone? I hope it's a write-in.
South Dakota versus Wade.
Oh, you want me to go back?
No, you're good.
All right. Just as a comment, whoever measured these blinds did a pretty poor job. Wonder if they had a surety bond. Anyway, hope everybody's doing good. Get to change the topic a little bit from all the numbers stuff. Thank goodness for all you guys that like those numbers. I'm more the other side of the brain, where it's not so much numbers. Talk about insurance and risk and kind of what we're seeing for the end of the year, what you might want to anticipate for next year. I can't really talk about the full year, but a lot of you have renewals, maybe insurance program renewals coming up 1/1 or that first quarter. So we're going to kind of look at what we're seeing towards the end of this year, last quarter, and the beginning of next year, just from a rate standpoint. And then like we always do, just talk about some risk issues. What should be on your radar? What do you need to think about that could affect your balance sheet, right? So we're going to dive into that. I want to get started, just kind of show this slide. I was going back through some old slides. And the first time I did this, we started off the presentation just, are we in a hard market, right? That was, a year and a half ago, 2 years ago, whatever, whenever it was. Then the last time I did it, I said, are we still in a hard market? That was kind of the question, and unfortunately the answer to that was yes, it was. We've kind of changed the question though, now, or the statement. It's, we're not still in a hard market, but we're definitely in a challenging market. So there's some analysis when we look at rates of what the majority of people are going to see, but then there's going to be a small percentage of you guys that I'm going to talk about, accounts, contractors, that are going to be outside of the norm, and it could still be kind of a painful process, and I'm going to give you a heads up and some things to think about there. So our agenda, again, like always, just look at some the insurance rate outlook, give you some heads up, some things you can do. Just insurance, some tips, best practices you can take back and help you maybe get through your renewal. And then really the big thing is, what are we seeing from some claims? What do you need to know about that can cost your company money? And you want to stay out of that if possible. So I just want to share this quick slide. This was from an organization called the Council of Insurance Agents and Brokers, and they survey a bunch of brokers like us, get input on all kinds of items. So they came out with their report for the second quarter of 2021. It was and they asked questions about what are they seeing on renewals and issues and all kinds of stuff. So second quarter, right, and I know it's a little bit late already, but second quarter was the 15th consecutive quarter of increased premiums. So it's been going on now for a while. Now the good news kind of is the average increase was only 8.3%. But what you got to remember as you start thinking about your own renewal, well, how do I benchmark? Where do I fit into that, right? Of that 8.3%, there's so many that are just little small accounts, right, that go into that factor. So I think that's fairly close, you know, what we're seeing in our kind of our business, closer to 10%, maybe more the average. Unfortunately, there's been a lot that go over that for various reasons, and we're going to get into that. But that gives you at least some benchmarking, right? Premiums increased for all lines of business. So what does that mean? So we got an average increase maybe of 8%. That's over all lines, right? So when we talk lines, and we're going to get into this in a minute, you know, property is a line, general liability is a line, auto is a line, right? So what does that mean? So basically, premiums across the board for all lines of business has also been going up. So we'll talk about that a little bit. And we'll get into this really in more details, that whole cyber conversation. So we're just seeing significant increases on if you have cyber liability, you know, it's going up and it can go up significantly. So we're going to talk about that. But on cyber, the thing I always put an asterisk by, because sometimes I get calls from my clients going, Joe, I've heard about this cyber problem and how much they're going up. Got to remember, cyber insurance is still relatively small compared to the rest of your coverages. So it could be, you know, a couple grand, maybe 10 grand at the highest. So if it goes up 20%, like, so what? I mean, it's a big increase percentage-wise, I know that, but you're not talking a lot of dollars. There's other areas that are going to cost you more money. And the other one is the umbrella. Again, I'm going to get into this in more detail. There's just a lot of pressure on umbrella excess market if you fit into one of these small buckets. For most of you, maybe it won't really matter, but some of you it's going to hurt, and it's going to continue to hurt on to next year, and we'll kind of talk about that a little bit. So the rate outlook. Some of these I'm going to gloss over because for contractors it doesn't really matter. You know, property, we're seeing things across the board, all over, right? Maybe like flat, up to 20%, but it depends on the type of property you have. So if you got a lot of habitational, a lot of frame buildings all over Columbus, renewal might hurt. Most contractors don't have that, so you guys really don't need to worry about that because you just don't have a lot of property. Contractors' equipment, that's a big one. But what we're seeing, particularly here in Ohio, Central Ohio, contractors' equipment still pretty competitive. Unless you got a lot of claims, you got a lot of issues, contractors' equipment rates should stay relatively flat, you know, maybe up a little bit. That's what we're seeing. General liability, that's a big one for contractors. So we put a range, and this is more from national type information that I gather. What we're seeing for our clients, for our contractors on the lower end for general liability, unless you're in one of those kind of hard, risky type construction. If you're street and road, you build bridges, you know, you might see more of a bump there. If you have claims are driving a lot of these issues. So if you have some claims issues, you're going to be at the higher end of that. But I think if you're GC, specialty trade, good claims history, you shouldn't be seeing a lot of a bump on your GL. Just give you that. But the other side of that is your auto. Auto is still the big problem in the insurance industry because of claims. Claims frequency and, more importantly, severity is just driving this. And this isn't going to end anytime soon, I don't think. There's just so much pressure on auto from insurance companies because they're just losing a lot of money. So claims that you think, you know, a few years ago weren't going to be paid out very much, you know, from a bodily injury standpoint, now are significant payouts, and there's many reasons for that. So you got bodily injury payouts that are driving it. And just think about the trucks that you guys are buying now, right? So you're buying a nice new pickup, you deck it out, you put all your stuff on there. It's $100 grand, right? So if those trucks get totaled, it's not like the old days. There's just significant payout. Even if it's not totaled, fender benders with all electronics and the airbags, significant pressure on auto. So you're going to continue to see, I think, some upward pressure on your auto, particularly for your contractors that have large fleets, you know, 50, 100 or more. there's just a lot of pressure there, and a lot of that is because I think the rates were too low before to sustain some of the losses that we've seen. So insurance companies are continuing to want to get rate there. And then if you have claims issues, that's going to be real problematic for you. You're going to see significant rate there, frequency, severity, and again, large fleet with big trucks. That's the other vocal point. Nothing you can do about it. If you're in a construction business, you got a lot of heavy trucks. You need those. There's nothing you can do about it. They're just going to cost you more money probably. So. Builder's risk, still real competitive for you GC people that are doing builder's risks. If you're building masonry, non-combustible type buildings, steel buildings, things are really good. A lot of insurance companies still want those. Rates are very competitive, may not even see any increase at all. The reverse of that is frame. You've heard me talk about this before. Unfortunately, the industry is not getting any better. Rates continue to go up. Capacity for insurance companies continue to go down. The number of insurance companies that we can go to get builder's risk for, let's say, projects over 10 million, right? So if you're a GC, that's really difficult. There's only 2-3 companies that want to do large frame. So think about all the multifamily, right, if you're doing that. So it's just very difficult market still. And the other thing, rates are going up. The other thing that you'll see is this water, fire, theft mitigation is what we refer to there. So security, fencing. There's also some things you can put on there from fire protection. They senses heat. And the other thing that's driving losses in frame projects, all these apartments, are water losses. Right? Water tanks get put up on the 5th, 6th floor. The water tank fails or was installed improperly. Water goes through the building for a weekend. Those are significant losses. So that's the other thing you'll see. And this umbrella, again, umbrella excess, this is just a real problem. For most of you guys, probably not be. But if you're a larger contractor and if you got 10 million or more in limits, this is where we're seeing the issue. It's a capacity issue. I've talked about this before. It's not getting better. So a lot of the insurance companies now, depending on what you do, coming back to that auto, right? Depending on the size of your fleet, they may say, hey, we don't want to do this high a limit anymore. We're not comfortable with this, again, capacity. So instead of doing 10 million, they're going to say, oh, we're only going to do 5, but we're going to do 5 for the same cost we did 10 last year. So then what we need to do, because you need those limits, right? We need to go out and get what's called layered, or putting layers together. So if you're a contractor and you got 15, 20 million, depending on what you do, this is where you're going to really see some increased cost. And sometimes is it available, right? So those are the issues that keep me up at night, give me more gray hair. Professional's pretty easy, not much there, not much to talk about really. Executive risk I'm going to talk about a little bit later because there's really problems here. And this is one of my risk management issues that for a takeaway is employment practices, right, with the whole COVID thing and other things that are going on. I think you got some real risk there, real exposure, and you need to be aware of it and be proactive on these issues. And the cyber, we're going to talk about that. So those are the two areas what we call executive risk type issues. And workers' comp, if you're doing, this isn't Ohio workers' comp, if you're doing work outside of Ohio, which many of you do, work comp's pretty easy. Rates are relatively flat or even down in some cases, which is a good thing, just as a comment. But not a big driver here, obviously. And Ohio, of course, they just keep giving all the money back. So I think one of my clients told me that, Joe, I think we have not paid like anything in Ohio workers' comp because whatever we've paid, they've like refunded the full amount to us. And how is that possible? So whatever they do. So we looked at this just real quick. I'm not going to spend a lot of time on this. Keep on track. But I shared this last time I think it was in January, just kind of looking at 21, how those was going to look. So it's kind of interesting just to look back real quick. Pretty spot on, all lines. They thought across 21 was going to be about up 11%. I think that was pretty close. I think we've, again, seen here with our clients on an average 10% or under. And how that's diced up on those individual lines is the issue. So they were pretty close. They missed the cyber totally. They only said 10% increase in cyber because I just don't think they we're looking forward and seeing all the claims that we're having with ransomware and attacks and things like that. So insurance tips, best practices. Still auto. Auto is the best thing you can do to help your renewal, and having the best practices put in place, right? So I put first, though, this is new, didn't talk about this before, a couple claims issues come up. This is something new, evaluations. So if you have an older truck, right, 2016, 2017, it's totaled, okay, you can't find, as you guys all know, right, you can't find trucks anymore. The used market is so inflated now to try to find a used truck. The insurance company is coming in and using their old actual cash value settlement, and they're giving you X, and if you have to go out and find that exact same vehicle, like, kind, and quality, right, not new, but like, kind, and quality, it's costing you more. It's a market-driven thing. So you may come across this. Just know you can negotiate, you can fight with the insurance company to try to get more, but it may require a little bit of work to show market value on those cars. So just something to keep in mind. The other thing is catalytic converters. Huge market for catalytic converters, unfortunately. So we're having a lot of clients that, you know, park their trucks in what they think is a secured yard. They go away for the weekend, they come back on Monday, and all their trucks, catalytic converters are cut out, right? So it's a huge market. Something to remember there, auto deductibles are per truck. So you can have a catalytic, if you have 5 trucks that are hit, 10 trucks that are hit, you got a deductible times 10. So it can be costly endeavor. So if anything you can do to secure your trucks a little bit more, depending on where you are, just know there's people trying to cut out your catalytic converters. Again, I'm going to go through these quickly. I've talked about them a lot. You have to have a fleet safety program, particularly for your contractors that are larger fleets. Got to have a written fleet safety program. Number one thing insurance companies are looking for, they want to know you got a program and that you use it, right? And when the loss control people come in, bring it out, talk about it, promote it, and say you're doing all the right things. It's really important to get competitive rates. Got to have a distracted driving policy. Got to have it in writing. Everybody's got to know about it. It's another one of those check marks. If you have it, you're going to get better rates. If you don't have it, you're not, and you may not even get optional proposals, right? Proactive. I talked about this again just to drive this home. It's a continuing issue. The old days, you could say, well, yeah, I call my insurance agent. They pull my motor vehicle reports for me. That doesn't work anymore. You can still do that, but what insurance companies want to know is that you are pulling the motor vehicle reports on your drivers, that you're being proactive, you're taking ownership on that. There's some systems that are pretty inexpensive. For contractors that have larger fleets, lots of drivers, you gotta do this and be able to say that you do it and demonstrate that you do it. Really important. Driver eligibility guidelines as part of your fleet safety program. Here's another thing that's starting to come up on renewals. Loss control people come out, they meet with you, they meet with your safety director, they send you a nice little follow-up letter. Hey, thanks for meeting with me. Hey, here's the things that we talked about, and this is what you need to do to improve. Boom, boom, boom. Hopefully it's a small list, but it can be large, whatever. As renewals come up now, underwriters are looking, have they responded to these loss control recs? In the old days, it never came up, right? Now it does, and if you don't respond in a positive way to these loss control recs, your rates are going up, or you may not even get a renewal. Right? They may say, hey, we're gonna non-renew this account. They're non-responsive. They're not taking this serious. So I've had a couple clients have had a call, and sometimes it's an innocent mistake. Oh yeah, I just missed the email. I just missed it, or safety person just missed it and forgot to respond. We'll do it now, right? It's really important. It's just something to stress. Telematics. Again, if you got a larger fleet, if you have invested, which I think is a good thing, if you have telematics, make sure your insurance agent knows, make sure your insurance company knows. It's going to benefit you on your renewal that you have telematics. It's a positive, it's a good check mark. General liability, I think we talked about this, so I'm going to go through this a little bit quicker. I've talked about it before, talked about it a lot. If you haven't updated your subcontract agreement, if you do sub work, do it now. Again, send it to your agent, send it to your insurance company. It needs to be up to date. That's going to be something the insurance company is going to want to see on your renewal. Part of it, loss control, fleet management, your subcontract agreement. It has to be up to date. There has to be good indemnity. Has to be good insurance requirements. So again, just send it on. It's a really good thing. Be proactive on it. And not only for your insurance rates, but it's just a good risk management thing, because what you're doing is you're transferring your risk to your subs, and you want to make sure it's up to date and it's proper. So that has to do with contractual risk transfer. Make sure you're getting signed contracts, you're getting certificates of insurance. You want to make sure you can demonstrate to loss control that you're being real proactive on that. I'm going to go through some of this quickly. Here, this is a good one I want to talk about, because we're seeing a lot of change in the marketplace right now. So for all you people, whether you're a GC or you're a subcontractor, make sure somebody's really reviewing your upstream contracts. We're starting to see a lot of changes, and this has been going on, but a lot of changes in those contracts that you're signing from an insurance requirement standpoint. And so what do I mean by that, right? So we're seeing higher limits of liability being requested, right? So maybe in the old days you were working for XYZ general contractor and it was a $5 million umbrella. Well, now it's being $10 million or more. We're seeing a lot of contracts that are coming down from owners and GCs that are requiring cyber now. And those are the things you don't want to miss. You want to make sure if that's in the insurance requirements, you're looking for it, you're getting a quote, and you're putting in that into your bid, because sometimes it can be pretty significant. So just something, again, to make sure you're doubling down on and checking those contracts. Again, we talked about this last time, but as a reminder, your renewal, if you probably already have it on your insurance policy, but you're going to get it again on the next renewal, is this communicable disease exclusion, and it's all COVID related, right? It's a COVID exclusion is what it is. And that's what it's going to look like, and there's really nothing you can do. Just know it's there. And so just risk management issues. So again, a couple of these I'm going to lightly touch on. Some of them I really want to focus on. Again, that auto is just so important for your rates and for risk, right? Got to have those things put in place. Cyber liability and crime. This is where we're seeing so many claims now, and they're significant. So it's not necessarily a frequency, like tool theft. Sometimes, unfortunately, auto can be a frequency issue. Cyber is not a frequency, it's a severity issue. So there's people, I've been involved in several of them, unfortunately. They're Eastern Europeans, right? That's what they say. Okay, so the Russians are after your money. That's what they want. So you got to do a lot of risk assessment. You have to do training of your people. Most of the times when malware gets into your system, it's because one of your employees has clicked on something that they shouldn't have clicked on, right? Doug.
I know we talked about it a lot, but with regard to cyber, some of the experiences we've had just in the last year, let's say, I think companies aren't targets, but we all are.
Yeah, I think people are just sometimes lie to themselves, like, oh yeah, they're just after the banks, they're after Walmart and that kind of stuff. That's just not true, right? And you know that because you've seen it, I've seen it. They're after everybody, and sometimes smaller companies are easier targets because you don't have the security in place, you don't have the training in place. The number of incidents that we've had in 2021 in the construction industry in Columbus this year has been significant. I read an article not too long ago about cyber, and 60% of the people that have had a cyber attack don't tell anybody about it. They're kind of embarrassed. It's like an employee dishonesty claim. They don't want to tell anybody, right? So I think it's happening even more than what people even talk about.
And to your point, the severity of what we've seen too is
Yes. Yes. Yeah. It's like a few years ago, Doug, that's a great comment. A few years ago, you always saw some high school kid down their basement and they're just trying to make like $1,000 or a couple $1,000 and da-da-da. That's not it anymore. These are crime syndicates that are doing this. They're going to hold you up for ransom. I'll get into this a little bit later. The ransomware extortion is huge, and it's hundreds of thousands of dollars. They want paid in Bitcoin, and they're serious.
And for the, for the bankers here too, it's something you want to certainly ask your clients, what kind of risk assessment are these clients doing, and what are the processes and procedures. We're all stretched thin, sometimes internal controls tend to be one of the first things that we really pay as much attention to, but you've got to understand the risks there.
Yeah, you have to do that. Probably the number one comment that I hear after I talk to my clients that have been hit by a cyber incident is, Joe, the IT person we were using, we thought they knew more than they did, right? Number one. Wish I had $5 every time I heard that. A lot of times it's just like, well, so-and-so down the hall, they do estimating, but they're kind of good at computers too, so they're that's not what you want to use. It's not what you want to use. So, Doug and his team, if you haven't used them yet, they have their own cybersecurity team that can come in, do testing and training, and it's worth whatever they charge. It's worth it. You just got to do that. So again, couple things you really need to do. I talked about this before. Open ports. Go back, look at your computer system. If you have an open port 445, 3389, you should not have those open. That's how sometimes they get in. So you really want to check on that. And then I'm going to talk about this here in a little bit. MFAs. And we're going to talk about that. This is new that I added. And this is probably the number one thing that you need to have. And depending on your insurance company, if you have cyber now, to get a renewal, you got to have these MFAs put in place. Or if you decide, hey, I need to get a quote, I should really have some good cyber insurance. If you don't have MFAs put in place, you may not be able to get even a cyber policy right now. Or what you're going to pay is going to be significantly increased because you don't have those MFAs. And we're going to look at those in a second. Employment practices. Again, this is a COVID-related thing. Just as a comment, when COVID first came out, March of 20, right? Seems like so long ago. Everybody's worried about their liability. Joe, what if somebody gets sick on my job site? What if somebody dies? Am I going to be liable? Those are a lot of those questions that we had. And we've had no claims from that, zero, right? Now, not that it can't happen, but we've seen none of that. But what could come up? So I have an article I wanted to share. And if you send me an email, I'll send it to you. It's from Liberty Mutual, did a little white paper. It's only 4 pages long, really pretty good. But what are they seeing from an employment practices standpoint moving forward? And these are all COVID really related, but it's what you don't think about, what can cost you money. Leave and discrimination claims, right? Number one. Number two, breach of contract. And those are breach of employment contracts, right? So you have a contract with somebody, one of your employees, and something happens COVID related, and you either have to downsize or you let them go. You can get involved in a breach of contract, an employment contract. So those are starting to come up. WARN Act, I don't think any of you have to worry about that. But wage and hour is another one. Wage and hour is huge. People are working from home. They're working too many hours. They don't, they're not taking their breaks. All kinds of things. These are where you're going to get wrapped into a wage and hour type violation and lawsuit. So if you want a little article on it, flip me an email. I'll be glad to send it to you. The other thing, again, from a liability standpoint, and this is from Business Insurance, and it talks about long COVID-19. Well, first I read that, I'm like, what is that? I've never heard that term before, long COVID-19. So put this down, you gotta write this down because you're gonna start hearing about it. But it's an effects from COVID. So if somebody, one of your employees gets COVID, right? Most of the time, you're out a couple days, whatever you do, you quarantine, whatever you're supposed to do, you come back, you're fine. But there's a small percentage, right, that are really sick, that have long-term effects, lungs, stamina, all kinds of issues, right? So think about that. So I'm gonna just read the first paragraph. The U.S. EEOC Commission, right, recognition that long COVID-19 may be considered a disability under the Americans with Disability Act and is expected to increase employers' potential liability. So anyway, So that just was posted on the 28th, September 28th. If you want this article, I'll be glad to send that to you, but you can also Google it. Through business insurance, the EEOC's move on long COVID-19. So put that kind of on your risk management list. Frame, we've talked about that. Don't need to talk about that anymore. Umbrella, I will say this, and just as a really good example on umbrellas, if you do work at Ohio State, if you do work for NG, this is just such a perfect example. NG's insurance requirements are just over the top ridiculous. So if any of you have not done work for NG before and you're thinking about it, before you do that, ask for their insurance requirements. Make sure you understand what you're getting into. I had a client of mine that was going to bid on a job direct to NG. It was going to be a $35,000 little job, but it was direct to NG. They sent their insurance requirements. Insurance requirements were going to cost $50,000 for that job. So, and of course we called them and said, do you want us to increase your umbrella and you want to do this? No, we're not bidding that job. So they're just ridiculous. So just, again, another kind of indication of what we're seeing in the marketplace. Wrap-ups, OSIPs, still really, really popular. We just have significant large jobs around Columbus. It's great. More Amazon buildings going up all over the place, got huge buildings, good projects. More wrap-ups, OSIPs, owner-controlled insurance programs, contractor-controlled insurance programs. Cyber, again, Doug, how am I doing on time? Okay, so I'm almost done. Cyber, we talked a lot about it. If you haven't done it, do yourself a favor on your renewal or at any time, just get a quote, right? Call your agent. I just want to get a cyber insurance quote. Get the cost. Evaluate the risk, talk to Doug or whoever you're working with, your IT company, evaluate the risk properly and make a really good informed decision. So what you're going to get really under a cyber, one, there's a lot of other good coverages, but you're going to get that extortion and ransomware. That's the big thing. And this other one we didn't talk about, but it's social engineering, wire transfer fraud. That's the other one that we're just seeing significant claims on. So again, you get an email, somebody in your accounts payable department gets an email from one of your vendor suppliers, one of your subcontractors. The hackers, the bad actors are getting so good at this. It looks so real. They reference previous conversations. They talk about your family. Say, oh, by the way, hey, when you go to pay us this $100,000 that we agreed that you owe us, here's our new routing number. We just changed banks, right? Went to Heartland Bank, we love them, but here's our new routing number, right? And that's fake. And as soon as you transfer that money, it's gone, and there's just significant losses. So you get that coverage under a cyber policy, under a crime policy. Just be careful. So I'm going to end with this, Doug, but this MFA, multi-factor authentication. A lot of times I ask people, hey, do you have MFAs on your system? And I get the look, like, I don't know what you're talking about, right? So you got to know, kind of what this is. If you have cyber, you should put this in place. If you want cyber, you should have it. Even if you don't have cyber and you don't want to buy insurance, you should have MFAs put in place. So this is a questionnaire that one of our insurance company uses, Travelers. So I'm going to just share this, right? So it gives you definitions of what MFAs are, so you understand what you need. This is really good, right? So I'm not going to read these, but I think you'll get the PowerPoint, so you'll know. But then this is the most important part, right? For Travelers and many other insurance companies, you have to be able to answer yes to these questions to be eligible for cyber insurance. So again, even if you don't buy insurance, this is best practice to keep you safe. Best practice so you don't have a hack, so you don't get somebody in there and cause you problems. So again, if you're interested in this, instead of just on the slide, if you want me to send this to you, I share this with a lot of clients just so they know what best practice is. And I'm going to skip this, Doug. So there you go. Any questions?
We've got a poll question
Ah,
there, so
there you go. Oh, sorry.
we'll be around after this question. We're going to transition to Scott and Melissa to talk a little.
So good morning, everyone. My name is Scott Bechtel, and tax partner in the Dublin office, and Melissa Dunkel, also tax partner in our Dublin office. I know one thing is it's definitely much better to do this in person instead of staring into the webcam and doing a Zoom or a Teams meeting. And I was sitting over here and looking at the sunrise and all of that, so definitely better to be in person. So I'm glad everybody could join us this morning. So we're just going to do an overview of kind of what we're seeing in the tax world, the federal tax situation right now. We're getting a lot of questions with the new administration and everything of, hey, where are we headed with tax changes? And honestly, right now, it's all pretty much proposals. And so we just want to highlight some of those. Kind of the flow of what we have is President Biden's tax plans back from what we heard at election time, and then update that for what was called the Green Book, which is kind of the administrative summary of his plan once he was in office, which gave us more detail, hit on some items more than others, and then fast forward that into the most recent House Ways and Means Committee plan that came out a couple weeks ago, which is really part of the infrastructure bills that we're hearing a lot about right now in the news. And then from there, just kind of highlight on some planning considerations. So as I said, obviously we heard everything at election time about what President Biden's plan was, and obviously the proposed increase in rates. And then in May of 2021 was when the Green Book was released, which, like I said, is an administrative summary of those plans and kind of more of the ultimate plan of how they propose to put those in place. So these slides are kind of a blend of both of those. The corporate rate so this would be for C corporations, the plan was to increase that currently flat rate of 21% that's in place under the Tax Cut and Jobs Act, to increase that to 28%. That 28% is kind of the middle of what the highest rate was before the Tax Cut and Jobs Act, and that flat 21%. So increase there for the C Corp situation. And then obviously a lot of our contractor clients are pass through, so that the individual rates come into play more in that situation. So the proposal is to increase the top marginal rate from 37%, where it currently stands, up to 39.6%, which was the old rate, and that would apply to anybody over the 400,000. There's also mention of phasing out the 199A deduction, which is the qualified business income deduction, which is a big piece of the legislation that happened a few years ago, and honestly a big benefit for pass-through entities. So it's talking about phasing that out if the income's over 400,000. We'll hit more on that in a little bit. And then the capital gains rates, we hear a lot about that currently and get a lot of questions of where do we see those headed. There's proposals from anywhere from bumping that current 20% all the way up to the ordinary rate of 39.6, and that would be on income over $1 million. But then you layer on top of that the 3.8% surtax that's already in place. We're talking we're pushing 45% then. So something to keep an eye on. In the Green Book, in that proposal, it included reference that the rates would be retroactive back to 4/28 of 21. So a gain that would happen today would fall under that new rate if this were to go through. We get a lot of questions about that and the retroactive piece. Typically in the tax world, when there are pieces of new legislation that are retroactive, Those typically are taxpayer friendly. This would not be the case. It would obviously increase the rate. So it's something to keep an eye on and continue to look at. And like I said, we'll update here a little bit more on more current. His plan also included imposing Social Security on payroll tax once you go over 400,000. So as everybody knows, Social Security withholding stops currently. It's capped. This year that cap is just shy of 143,000. What this proposal would do is there would be a gap where you would not pay it, and then if your W-2 wages went over 400, it would kick it back in. Interesting concept. Not sure where that would go going forward. Yes.
12.4 is both sides.
Correct. It's 6.2% employee, 6.2 employer. Sorry about that. So this slide just quickly highlights some of the rate history of the old law and then what came about with the Tax Cut and Jobs Act, and then the proposed different rates under the Biden plan. Currently, his plan used the 400,000. You'll see 400, 450. It's all kind of in that range where a lot of these things are coming into play in the threshold. I mentioned the qualified business income deduction or the 199A deduction and how that was a significant benefit for pass-throughs. And effectively what that does is it takes the tax rate from the 37% down to 29.6% on that income. So if that were to go away, obviously, and then go up to 39.6, right there is a 10% increase, and we'll get into some other things that could even be more of an increase. Then there's also discussion of repeal of the like-kind exchange. Currently, like-kind exchange is only available for real estate. It used to be available on equipment and other assets, but that went away a few years ago with the tax changes, and this proposes that there would either be a phase out or a cap on that under these proposals. The proposals also included a lot of changes to the itemized deductions, which kind of was a response to the changes that occurred back under the Tax Cut and Jobs Act. These were not really mentioned in the Green Book, so I'm not going to go into much detail on these, and they really are not being hit on a whole lot with the House Ways and Means. So it's just some of those changes that have happened and where those may go, including that cap. One of the popular discussion points is the cap on the state and local taxes of 10,000. So in a state like Ohio, we've got the income tax, then we've got the city income tax, and then your real estate taxes. It's not hard to get to that 10,000. So that's one of the things that's still there. Inheritance and estate tax, I'm going to kind of skip over that because it wasn't really as much of a part of the Green Book, but is more of a part of the House Ways and Means plan. Looks like we have.
We're answering the poll question here. Some of those provisions under the Tax Cut and Jobs Act are scheduled to sunset anyway, correct?
Correct. Yeah, so the Tax Cut and Jobs Act went through as part of a budget reconciliation where they have to apply that where it kind of either sunsets or it's paid for through some other mechanism. So typically those sunsets happen under the next potential administration and midway through their office. So yes, some of those items are set to sunset in the next few years. We'll hit on a couple of those, but so that's part of it to keep an eye on anyhow. Everybody have time to answer? So back right before our nice 9/15 tax deadline, the House Ways and Means decided to release some new legislation or proposed legislation highlighting some of the tax changes that are currently kind of built into these infrastructure bills that are being debated in Washington as we sit here. Most of these are effective as of December 31st. But the capital gains that I mentioned earlier, that the Green Book highlighted that April cutoff for when gains would be applied, or the capital gain rate would be applied to transactions. This kicks it out to the day this was released, which was 9/13. So the window's getting smaller towards year end here, and we'll continue to keep an eye on what that may mean. So under the House Ways and Means Committee plan, the corporate rate still would increase, but it's replaced by a graduated rate, which is kind of more of the old mechanism where it went up to 35%, but their proposal is up to 26.5%. So it's not all the way up to where it used to be, not up to the 28% that was under the other proposal, but still an increase. And so this would once again apply to C Corps. The interest deduction limitation, which came about a few years ago, that would still be in play. From the individual side, it would still go up to the 39.6%. And like I said, there's a threshold of 400 or 450 that's kind of tossed back and forth between these proposals. It also would include a 3% surcharge tax if you have modified adjusted gross income over 5 million. So what's starting to happen in some of these is adding additional tax, not only a higher rate, but additional charges for that 1% that they're saying that going to get taxed from. So there's different pieces to it, or layers that we're keeping an eye on. A big item here is these proposals would apply the net investment income tax to ordinary income. So this would be pass-through income coming through from like an S Corp or LLC. Currently, that 3.8% is on investment income. So things that you're not actively in business, or not active in, so more of a passive investment. There's talk of trying to apply that additional 3.8% to regular operating income. So if you think about what I mentioned before, there's a phase out, or the 199A deduction goes away, which is effectively taking your rate currently from 37 down to 29.6. If we go up to 39.6, there's obviously a 10% increase right there, and then this would layer on another 3.8. So that income that's currently being taxed at 29.6 is going to be like 44%. It also, but at the same time, in this House Ways and Means, it's more of a cap. They bring up a cap on the qualified business income. So this is kind of taking us back away, that maybe they won't do away with it, but they would cap it at a $500,000 deduction. So I think we're talking like $2.5 million of income before we would get to that. So once again, it's one of the things that's kind of a moving target, and we're just looking at all the proposals and seeing what is out there. Long-term capital gain rates under this would not go up to ordinary. It would be 25% for any tax year ending after September 13th of 2021, but there would be some transition rules, and that's where some of these items that may have already been in contract this year may get sunsetted into the old rate. So it's still kind of murky on exactly where that will go. And the House Ways and Means, like I said, the itemized deduction changes have kind of fallen out of what we're seeing in the proposals, so there's really no mention on that 10% state and local, or 10,000 cap on state and local taxes. Is this where you? We're going to go back and forth, but
That'd be
with
too
time,
confusing.
we'll do that.
Doug, how are we on time?
We've got 10 to 15 minutes.
Okay. So I think I drew the short straw because neither one of us are gift and estate or trust experts, but I'm going to tackle this area for what we have to update with the House Ways and Means Committee report, as well as some retirement plan changes and where this kind of stands from a legislative standpoint. So if you recall, the big question that people keep asking is what's going to happen with the gift estate exemption. Right now it's about 11.7 million per individual. So for married couples, you're over 22 million for that lifetime exemption. The question being, how much is it going to drop? We know it's going to drop. That's been the discussion for a while now. And as Scott mentioned briefly, with the Green Book versus Biden's initial proposals, there's been a lot of back and forth. So the House Ways and Means Committee report came out to say that number is going to be roughly 5 million per individual, 10 million per couple. Once you get inflation adjusted, it's more like 6 million, a little over 6 million per individual. So that's a big, significant change. It's not as bad as we heard it could be, but it's still a big drop for certain individuals, those really high net worth taxpayers that have some planning to do. If you're in that boat, if you know people that are in that boat, and you're not meeting with your advisors, your attorneys, your accountants, whoever that may be, your investment advisors, get those meetings scheduled because you may want something to occur before the end of the year. Two things out of that were not really addressed in this House Ways and Means Committee report is the discussion of would the 40% tax rate change and what would that look like? That wasn't mentioned in this. Additionally, looking at grantor trusts, which was something I don't think that was really talked about before in either of the other proposals that were out, but grantor trusts, the benefit of those is the ability to take assets from your estate, move them into a grantor trust, still pay the tax associated with any income that's generated, and it's not part of your estate upon death. This essentially says there's no point to doing these anymore because once you pass, we're going to include it in your estate, and you're going to pay tax on it. Now, this is for trusts that are created on or after the date of enactment, as well as if you end up contributing new assets into an existing grantor trust on or after the date of enactment. So that was just something that, again, I think we didn't really see coming before. It wasn't talked about that I could remember. The other piece that was talked about, again, but not in this report, was the potential elimination for a step up in basis of your assets upon death. That was not addressed here either. So more questions, which I think if you've paid attention the past 18 months, 2 years, we tend to get information that generates more questions and not get the full picture at any time that's helpful.
And those grantor trusts have been a significant tool used in gift and estate planning over the years and shifting that into the estate. So that would be a significant change.
Retirement plans, that was another area that really wasn't addressed in much of this prior legislation or proposals that we've looked at. If you recall, in Biden's campaign, he hovered around that $400,000 a lot for where changes were going to impact individuals. And we're seeing that with some of these retirement plan proposals. And that's really looking at the prohibition of additional contributions to Roth or traditional IRAs when your value exceeds $10 million or more. And then there's income threshold levels that this applies to. Additionally, Roth conversions or the ability to contribute to Roth IRAs, there's some potential for those to change rather significantly for people if you're used to that. The big thing that we see often, because if you recall, to contribute to a Roth IRA currently, you have to be within certain income thresholds. And once you get above, let's say it's roughly $208,000 for 2021, once your income is over that, you can't contribute. You don't have the option. So a lot of taxpayers do this backdoor Roth that we see that is another planning vehicle of contributing non-deductible contributions and then converting it to a Roth, letting those grow tax-free and withdraw the money without paying tax down the road. Essentially, that really puts a hindrance on that plan. There's various levels of degrees of what that would look like. Some eliminate entirely, some are based on your income threshold. So that was something we hadn't seen or heard about previously. Similarly, RMDs, or required minimum distributions, again, same income threshold parameters as the previous slide, hovering around that 400, 425, 450 income thresholds. But basically, it's looking at if you have assets around $10 million and you're exceeding those, you're going to be required to take a certain percentage as a required minimum distribution. There's also some parameters around that 20 million and what that looks like. These were all things that, again, were not something we'd previously seen or discussed. And I think as you're looking long-term and planning long-term, it's definitely things to think about and take into consideration as you're approaching retirement or considering long-term plans. So with all of this fun new information, and Scott and I were actually talking a few weeks ago about what we were going to talk about, because up to 9/13 we didn't really have any new information to share. So then, this came out, and today, if you're not aware, the House is set to vote on the $1 trillion infrastructure bill. So I'm sure everybody will be watching the news, looking at that later. It was supposed to happen, I think, Monday, but then it got pushed till today. So where does that really leave us? Well, there's kind of two components, the $1 trillion infrastructure bill and the $3.5 trillion infrastructure bill. The 3.5 is really where we're probably spending our time looking at how are these tax law changes going to be funded and impacted, because that's where part of that funding is coming from. As you can guess, there's going to be back and forth. We've not had a simple process for any of these changes. There's going to be disagreements and negotiations, so we're all kind of in the same boat as you of trying to figure out what's going to get passed and what's not. And we have a polling question.
And I think while we're doing that, just kind of a highlight on those infrastructure bills is right now, as you're seeing in the news, there's those two bills, and there's a play of, hey, we don't want to vote on this one until this one comes along, and you'll have our vote if it's all at the same time, but you won't have our vote if this gets split up. And now there's discussion of that 3.5 trillion one. Will it get cut back because of that, and will that number come down? And then what is the impact of that on the tax changes that would fund those bills? So right now, it's a total moving target as we sit here, and we're watching. And honestly, I was looking at my phone as some of the other presenters were presenting this morning to see if there's any update on it. But we've also got the government shutdown and funding issue on their plate today. And so one of the questions is just, how is this going to all play out?
There's also been some chatter about taxing unrealized gains. Have you guys heard anything about that?
I actually have not.
So through like an individual that has unrealized gain in investments? Yeah, it's one of the things that I've heard out there is a consideration. I think as you look at some of the retirement changes or proposals, what you're seeing is they're trying to increase lower income individuals' activity in trying to save and do that, but at the same time cap the ultra wealthy and what they can save and what they have saved. So I think that's where some of those proposals are coming about. I don't think it's part of like the bills that are all the way out to real consideration right now, but it is something that I have heard is an idea. Scary idea.
So as Scott mentioned a little bit, through this budget reconciliation process, the Senate just needs a majority, 51 votes, to pass this. And the budget reconciliation can only be used for bills that impact revenue or spending. So, tax bills fall within that mechanism. And I think you also stated that, we've seen this before. It's not uncommon. 2001, 2003, tax law changes were put through budget reconciliation. That was more Scott's time frame, not mine. I didn't do taxes back then, but but I remember 2010 briefly. I had to add some humor. It's taxes. How can you make this interesting?
I didn't know I was going to be the target.
2010, remember a little bit. 2017 is the one that we're really living in, right? It's the Tax Cuts and Jobs Act. It's the one that we've been dealing with for the past 4 years, plus COVID impact and those changes that we've had to implement as well. So I think one of the questions that we've talked about back and forth is, based on the fact that that the government is putting all this funding into the economy to help the economy, now we're going to turn around and tax a bunch of the income that everybody's earning. So what does that look like? What is the balance between that? As Scott said, I think we're just all kind of in a waiting game and trying to figure out what will actually get passed and what won't. So planning considerations, we've talked a lot about accelerating income, deferring deductions if your tax rates are going to go up. There's definitely planning around that, and something that we're seeing a lot right now is clients going through transactions, buying or selling businesses, whatever that might be. For those of you that may be looking at selling your business, or maybe you already did and you're looking at, okay, is this going to be an installment sale situation? The benefit of an installment sale historically has been you're paying tax when you get the cash. So, it makes sense in that regard. But in this case, you're delaying that payment in years that could have higher tax rates. On the flip side, if you don't have the ability to accelerate it all in the year that it occurs, let's say just before 2022, you have to pay the tax. If you don't have that cash, how are you going to do it? So there's that balance of dollars of what makes sense for you individually. A lot of the deductions we talk about deferring naturally focus around depreciation, because pumping money into the economy through purchasing assets is a great way to reduce your tax bill at the same time, especially with the 100% bonus right now. But looking down the road, does that make sense in the climate that we're in, with the potential for those rates to go up? So we like to add this information because typically we get the question of, when does the 100% bonus depreciating change? How much time do we have? So currently, it's set through December 31st, 2022, and then gradually drops after that.
And that's been a significant tool in bringing down taxable income to contractors that have a lot of equipment, acquisition and so forth. Talking through with clients how big the swings have been between their book income and their taxable income because of depreciation, and then last year, like backing things out like PPP and some of those items of, okay, if we're looking as we're doing planning this year, we really need to look at what book income obviously is the starting point, and then what some of those swings are like. Because what is happening with the depreciation is, if you add a lot of equipment in one year and then back that way off in the next year, there's can be some pretty significant swings over time as it relates to that benefit. And then when you layer in going forward that this is going to get phased out, it's kind of looking at what that means. So it's one of the probably the top two questions I get asked is, what's the schedule of when this is going to phase out? Because I mean, honestly, right now we're seeing some situations where losses are being created because there's been so much bonus depreciation taken, and so there hasn't been tax being paid. And then going forward, what does it look like when that goes away or phases down? So
I think that was everything that we had. If there's any other questions, or I know, as Doug mentioned, we'll all be around for a little bit if you do have anything.
Thank you, Melissa and Scott, and thanks to everybody for coming out today. I know it was a lot of material that we went through in a fairly short period of time, but I know we're up against time here at 10, so if you've got to head out, we certainly understand, but we will be around for individual questions, and of course, reach out to us personally if you want to discuss any situations in greater detail. So thanks to Joe and Jim and Melissa and Scott and Joe Pop as well, who had to leave for their efforts today, and hopefully you learned a little something. So thanks again, and great to see everybody.